Welcome to Wealth Coffee Chats, folks, for your daily live updates. Get the most out of today's episode by participating in the chat. Make sure you ask some questions, be part of the conversation, have a bit of fun, grab a coffee or a tea, take some notes, and get ready to start your day, folks. Quick few housekeeping rules, though. No spamming, no advertising or self-promotion in the chat. That's not on. Be kind and respectful to everyone when participating. And most of all, have a good time. Real estate investing can be your biggest asset. It also can be your most expensive asset when it comes to getting it right or getting it wrong, folks. It can be time-consuming, stressful, and that's why here at Positive, we have what's called a 6-star team, a full-service team that provides integrated wealth and property investing solutions and services simply designed to help you progress towards your goal of passive income through your property portfolio, folks. Make sure you check out our other podcasts on the Positive Mentor Network. Not only is there Wealth Coffee Chats, there's the Urban Property Investor. Drops every Wednesday with straight talking investing strategies and lessons with Sam Saggers. Property Investor Tales. This is where our clients, you guys, share real life stories from property investing, hosted by some of our advisors and strategists. And that's done every fortnight, dropping every Monday. Wealth, Wine and Wisdom, folks, that debriefs the week that was in the world of finance and property, hosted by yours truly, Jason Witten and Andy Fenton on Fridays. Hey, good morning, folks.
Good morning, everybody. Welcome to another Wealth Coffee Chat.
Hope you're well, folks, wherever you are.
There it is, team. Morning. Morning, wherever you're tuning in from today.
Early bird gets the worm, they say. Here at Positive, we offer a 6-star team. It's a team that help you at every stage of your wealth creation journey.
Welcome, everyone, to Wealth Coffee Chats. Hope you're bringing your coffee along. Today, I'm going to be talking about the Australian market overall, but from a statistical perspective. So I've got a whole bunch of data here from the ABS. Looking at ABS 6432, the total value of dwellings, and table 2 here. We're mostly looking at the capital cities for median price, and we're looking at houses and units across these cities. So we'll start here. Feel free to put any questions you have in the chat as we go along. So the median house prices as they sit at June 2025, we're looking at Sydney being the front runner, which is always the case at 1,460,000, 1.4 million. And then we're going over to Canberra here in second, Brisbane, Adelaide, Perth, all kicking in front of Melbourne. And we've got Hobart and Adelaide sitting in the final 2 places out of our capital cities. So over the longer term, what we usually see with price action is for our capital cities. When the cities catch up to Sydney, Sydney will usually have a bit of a boom and start to pull away. When they play a bit of catch up again, Sydney will start to boom and pull away. You also see similar sort of price behavior with Melbourne. So we've got Melbourne here. When Melbourne lags behind for a bit, it generally plays a bit of a catch up. When Brisbane catches up to Melbourne, Melbourne usually has a bit of a push ahead. Now, it's important to remember that past performance isn't always a reliable indicator of future performance, and that you've got to be very aware as to what is actually going on in these markets and understand the story behind why these markets behave this way. I'll go into a bit more detail about that, especially with Melbourne and Brisbane as we go through this session. Looking at unit prices, we have Sydney once again out the front here, but to a lesser degree this time around. We've got Brisbane playing quite a bit of catch up, Adelaide and Perth. And then we've got Melbourne here, slightly ahead of Perth for now. Probably not by the time, where are we now, November? That's probably changed now. We've got Hobart and Darwin as our lower price markets once again. And if we look at unit price action, similar sort of thing over the long term on a chart. We've got these charts going back to 2003, which is when the ABS introduced their current data collection process. So it's consistent across all these years. So when this other cities catch up to Sydney, Sydney starts to have a bit of a boom and take away. And when the other cities catch up to Melbourne as well, Melbourne tends to have a bit of a rebound following afterwards. So what we have on this chart here is relative median house prices. What I'm trying to show here, it's a bit of a mouthful to get out. We're looking at the price of Canberra as at June 2025 as the first one here, and comparing it to its long-term average when compared to Sydney. So Canberra price divided by Sydney today, Canberra price divided by Sydney over the long term. Where the green line is below the blue line, or is a smaller value than the blue line, that means that the value today is less than its long-term average as a comparison to the Sydney market, or to the market that we have listed at the top here. So if we look at Darwin, we can see that Darwin is currently in a much lower price market environment than what it would usually be. It's sitting here at 0.442 roughly, when usually it's around 0.59. There's a few reasons for that. The market in Darwin is very volatile. If we're looking at Brisbane, you can see that Brisbane has kind of edged out ahead. It is now a bit in front of its long-term price relationship with Sydney. And if you look at Melbourne, you can see that Melbourne's quite a bit behind its long-term relationship with Sydney. You know, it could be because of factors local. It could be because of factors in the Sydney market itself. I like to use Sydney as a comparison, as at least the first comparison, because it is the major market. It is the main market. And I believe it's a reliable one to compare the rest of the cities. Because if you have a look at these charts, it usually is the one that is all the way ahead. When there is a catch up, Sydney starts to rebound. You can read into that a bit. Looking at unit prices on the right here, you can see similar sort of pricing behavior, except for Hobart, Perth, Adelaide, Brisbane. Their unit markets are a little bit higher than their longer term average when compared to Sydney, especially Perth, Adelaide, and Brisbane with their recent growth experience. You can see here Melbourne's a little bit behind. So if you can compare to Melbourne, the reason I want to compare to Melbourne is just to show the value that is in the Melbourne marketplace compared to the other cities. So Canberra is probably a bit more expensive than its long-term relationship with Melbourne. Darwin's a little bit cheaper. Hobart's a bit more expensive. Then you've got Perth, Adelaide, and Brisbane. They're quite a bit more expensive. And then you've got Sydney here as well. When you're looking at it from this perspective, it is quite a bit more expensive than what you would expect for the long-term average of Melbourne to be. And we've got similar pricing behavior over here for the units as well, especially Perth, Adelaide, and Brisbane again. Got a comparison here of correlation across the market. So we'll start here with correlation across houses. It's a big screen of numbers here. It's pretty dull to look at, so I decided to make it a bit more festive and a bit more Halloween with some bright colors and a little bit of joy on the slide. But basically what we're looking at here is, we'll start with a quick comparison. So this is houses, this is units. This is houses, this is units. So first point, high correlation across markets with houses. The reason that will be is because you'll have probably more macro factors influencing houses across the board. Things like availability of credit, economic growth, overall health of the economy, directly impacting housing and land prices. Units a lot more dependent on the micro market environment. Employment drivers that are near these units, these are higher density dwellings, so you do need to have those employment drivers nearby. They'll be highly dependent on the infrastructure that's available, the health of the micro economy, the demographics, all that sort of thing. But when we're looking at, back to houses here, we're looking at the correlation between the cities. You can see that Sydney and Melbourne, they have the highest correlation out of any of the cities at 0.8. Then you've got Brisbane and Adelaide with 0.77. Anything above 0.7, you could say, will have some kind of, relatively strong correlation relationship. Anything below 0.3 would mean not a correlating relationship. So that means the prices will operate independently of each other. There's not much relationship between them at all. Between 0.3 and 0.5, which is where you'll find most of the actual house, the price behavior between houses sitting. There could be a bit of a relationship. There's not a whole lot that would actually suggest that it's a strong relationship. It's just something that's there. I do put it down to those macro factors being fairly similar across the cities, and these housing estates usually being much less, well, definitely being much less dense than what you'd find in apartment complexes and that sort of thing. So with units, you can see here the highest correlation we have will be Sydney and Melbourne once again, 0.6. And then even with Brisbane and Adelaide here, they're sitting at around 0.3, which would suggest just slightly above a lack of correlation. And Perth is sitting here correlating with Brisbane's market at around 0.5. Other than that, there's just no relationship. So that means, it is very important to select the right market when you're looking at units. It is very microeconomic dependent. That's how our acquisitions team comes into play, to absolutely vet anything that isn't worth investing in and reduce our investable universe to high quality assets. And it's also a great way to diversify. If you are looking to have a portfolio of non-correlating assets, apartments can really help out on that front. So have a look at a few of the statistical measures here. So we've got, there's quite a bit of text here. I won't go into too much detail. It's just describing what type of distribution you would expect these markets to have. I'll highlight some of the more interesting ones. So if we're looking, but when we're measuring risk, I generally measure risk as, well, when you're looking at a standard deviation, it's a measurement of volatility both on the upside and the downside. I'm not particularly worried about having significant upside risk. I'll prefer to chase upside risk. What I'm worried about is the downside risk. And it's quite interesting when you make a differentiation, when you differentiate between the two, what that looks like from an investment point of view. So we've got downside risk here, and then below it, the two lines will have the upside risk. So I'll run over this now, just highlight it and run over it with you. Yeah, there we go. All right, so we've got our global cities, just in general, are a bit more volatile. Once you're a global city, your yields are lower, your prices are a lot more dependent, or a lot more reactive to any macro and micro forces that might hit that market. Sydney and Melbourne are volatile on the upside and the downside. Brisbane and Adelaide, they don't have a lot of downside risk. You're looking at 1.79% here below the mean, or below zero, making a loss, I mean by that. 0.88, 0.66, significantly lower than the other cities. That's been the recent price experience. You've got Perth, a bit of downside volatility, Hobart, a bit of downside volatility. You'll see Darwin and Canberra will have a bit of downside volatility. And below here as well, we've got the upside volatility. So around that 2 to 3 above the mean, it's pretty normal. And you've got our global cities sitting at 4 and 3.5. So what does that mean? Global city is a bit more volatile, lower yields. You expect that price action to be a bit more wavy. It does have significant upside potential, also has a bit of downside potential. That's where Brisbane comes into play. So Brisbane is on its way to becoming more of a global city. It's got the International Olympics coming in 2032. It's going to put Brisbane on the stage. You can see that the price action in Brisbane and its recent experience is starting to display the behavior of a global city. It's getting more expensive. We will eventually see those yields continue to fall to levels comparable to Sydney and Melbourne. And then you'll have this market starting to experience volatile behavior on the downside. So that'll be basically a change in market behavior. Right now, we're ramping up to the point where it is a global city. When it's a global city, you'll know when you have a significant pullback at some point that you weren't expecting. That is now the change in market behavior and the new norm. That's what I'm predicting, at least. So what does it mean for Brisbane? At the moment, you'd look at Brisbane being this positive skew type distribution. It's also quite leptokurtic as well. And what does that mean? Well, compared to the other cities, it just means that a lot of its returns are just sitting in this same little narrow sort of field. So if you look at Sydney, this is a distribution of the median price growth rates across the city. Note that these the values on the left axis here, these are different. If you're looking at Brisbane's, it'll actually be about twice as tall as what it's showing here. So taller and skinnier distribution like this with a positive skew. Compared to Sydney, it's a bit flatter, a bit wider. Sydney's got this upside potential, but also downside potential. This is a distribution of quarterly growth rates. If you have a look at Melbourne, similar sort of distribution to Sydney, a bit of downside risk, a bit of upside risk, spread all across the board. And then you can see the difference with Brisbane. It is quite a different price action that market experiences, at least since 2022, since we have the current same comparable data. If we have a look at Adelaide, you can see it's a bit narrower as well. Got the axis going up to a higher number here. If you look at Perth, it's a bit more spread out, a bit of an upside risk up this way, but it also does have some periods where it can pull back quite significantly. And then the quarterly price data in Hobart, bit of upside potential here, but also a bit of downside volatility. Looking at houses here with Darwin. Darwin is a bit different. There is a significant downside risk in Darwin, especially when you compare it to its upside. And looking at Canberra, you can see that there is a bit of downside risk in the Canberra market as well, but it's usually sitting around this middle point. All right, so that's houses. Now we'll have a look at units. We'll see similar sort of relationships. So the major cities, while their unit markets are less volatile, they're more stable. The major global cities still have, they actually have less risk than some of the smaller markets. The standard deviation here, 3% roughly for Sydney and Melbourne. Adelaide, Perth, Hobart, Darwin, Canberra, other than Canberra, higher than Sydney and Melbourne. If we're having a look at the downside with these ones as well, so we'll highlight this section to make it a bit easier to see. So this is the downside. You can see that the smaller cities actually have more downside risk when it comes to apartments and units. If we're looking at the upside, some of the markets have more of an upside. We've got Adelaide, Perth, Hobart, and Darwin. Darwin especially has a strong upside. It's pretty much to offset that strong downside that it has. Is there a skewness in these markets? Not really. Maybe a little bit with Perth, maybe a little bit with Melbourne, but not really. Pretty negligible. So this is what these distributions look like. So you can see here, the Sydney market, it's a good one to compare to. Quite different to its housing market distribution, where it's all over the shop. It's a bit tighter controlled. Melbourne, not too dissimilar from Sydney. Brisbane, quite similar as well in its distribution. Adelaide, Perth, similar. You can see a bit of volatility in Perth, volatility on the upside, a bit of volatility on the downside. It's the nature of its market. And then Hobart as well. You've got some significant downside volatility with a bit of upside. Then we've got Darwin's unit market. Look at that. That's what happens when you have a unit market in a place that can't always support a unit market. It is volatile. It is very, very much very much dependent on local microeconomic factors. And in a volatile kind of economy like Darwin's, you can see that the prices of these units, they're all over the shop. And then Canberra, a little bit more normalcy. All right, well, that's the end of my presentation. Basically, the main takeaways are houses do have a bit more correlation across marketplaces. Units can be a great way to really narrow down on that microeconomic growth, really getting into the right opportunity at the right market, at the right price, at the right time. And you can have some growth which is non-correlating to other marketplaces. That's pretty much it. If you have any questions, feel free to reach out to me. My name's Tim Gilderdale, property consultant, and we'll leave it there. Cheers.
Thanks for watching another episode of Wealth Coffee Chat, folks. Make sure you like, subscribe, and turn on your notifications so you never miss a thing when we go live. Improve your portfolio and investing game, folks, with Wealth Coffee Chats live every morning at 8:10 each weekday. Make sure you join us. Previous episodes are also available wherever you get your podcasts, folks, as well as our other podcasts from the 6-Star team here at positivementor.com.au.